Hello everyone, this is Juan Sarmiento and today is Friday, January the 13th. Let's go quickly through our current positions. Things are not looking good this year. The volatility has dropped dramatically and the markets have been rocketing. Yeah, it will be good if they move strongly up, but the volatility is declining and that's not good for our positions. Okay, but by the same token, once the volatility declines this far down, chances are it will bounce back up. So what do? We enter new positions. I look at positions, possible positions, and I have here one on CRM. And you can see that it has all the items here are trade. The earnings were a while back in November and they were excellent and they beat expectations, yet the stock continued to go down and now it's rebounding very nicely. The volatility skew is positive, meaning that it's no more than 2% difference between the long options and the short options of our trade. So you can see the average is 38 for the longs and 36, close to 36 for the short. So that's about a little over 2%, so that's tradable. The liquidity is very low, and you can see very liquid because the difference between the mid and the natural price of the trade that I'm entering is 1.4, which is below 3%, so that's very good. And the current IV percentile is 6%. So let's take a quick look at CRM, a chart of the CRM. And here it is, CRM is doing really well. Volatility has dropped significantly, as you can see, and it's one of those that have benefited from the drop in volatility. The earnings came back, and at the time it was really good, but the stock went down anyway, pressure of the market I presume, and now it's coming back up. And you can see that the volatility is here. First of all, the chart is green. If you know the script that I'm using here, or if you don't, just ask for it and I'll send it to you, the script that you need to generate this position, to generate this chart. And so when the line is green, it means that the volatility is higher, the implied volatility is lower than the historical volatility, which means the volatility is low and it's a good trade to enter. So I have my trade here, which I copied. I'm just going to copy it and then take it to the platform here, and then we'll discuss it. Okay, so I'm going to go here and say I'm going to add it here, and then say analyze trade. And here you have it. You have the long says 41. I think that's an error for this platform because I was just trading it at 38. So this is definitely wrong. Let me open here. Yeah, that's the price I paid. I don't know why it gives me this 41. It generates a confusion because this is not right. In the real trading account, this will be 38, this will be 38, this will be 35 and 35. So there is a confusion there. I'm going to have to ask the broker what's going on here. This may be an error. So I'm going to enter it anyway. If you have a real account, you would see that there's a difference. If you see that it's more like this, like the one I showed here, 38 for the longs and 36 for the shorts, then you're free to do it. You're not to be concerned with this. What I'm getting here is probably not right. So I'm going to enter that trade. How many do I need to do? Well, I'll say create duplicate order, confirm and send, and I say multiple. So then in my account here, I see how much I'm paying for it. This is 4,000 for one of them. Two of them will be 8,000. So yeah, that's about 10% of my account. So that's what I'm going to enter. If I enter 3, then it will be 12,000. That's not what I want. I want 8,000 total because it's 10% of my account. And there it is. Now you see, no, it's still the wrong numbers here. Okay. All right, we'll have to see. Let's organize our trades that we have here so far in this order. So we have CAT, and you can see that we have 2 shorts for the call side. Okay, so 1 long call. Okay, so you can see that we have 1 short call, 1 long call. They cancel each other, so we end up with a calendar spread, so to speak. Okay, then we have 4 puts long, 1 put short. I don't think we want to add 1 more put. We could. Okay, let's do that. Let's add 1 more put, sell it. So then we have 4 long puts, 1 short put, and we're adding 93. Okay, that's worth it. It's worth adding. If it was 30 cents, it doesn't matter. It's 93 cents. That's worth adding. So let's do that. And make sure that it's the right date. Expiration February 10. Yeah. So we'll end up with 2 short puts. All right. And that not only it neutralizes, it actually increases my delta, because here's where we have our deltas. And the calls match. Okay, so we have 1 extra call here at 240, and this stock is trading at 257. So we can roll this up. This 1 call could go higher as to reduce my deltas and take profits. So I'm going to analyze rolling. And so I'm going to sell this February 240 call, and I'm going to buy the 260 call. And that should, there it goes. Needs to be the same. Yeah, and that reduces then my deltas to 24, and I recover almost $13. Let's put 13. Okay. You can put whatever price you want and then reduce it. Okay, this is a little above market. And then if the market continues higher, it will fill. Okay, so this 240 call goes away and 260 gets in its place, so as to remain delta positive. Let's CRM, let's take a look at that. Yeah, that looks good. Let's go to Cisco. Let's reduce all this. Okay, so we have, is delta negative? Oh, we have this puts. You see these puts here? Those are expiring today. Okay, so we could sell puts. Okay, the same strike price to say puts. 10 of them, so 10 plus 10 equals 20, and you sell that, and of course this is what it creates. It doesn't matter, because this January 45 puts are going to expire today, and then it will look exactly as it is usually look like. I would sell only 19 cents. 19 cents. It's not even worth it, is it? 19 cents. Let's see how much money I'm going to create. Confirm, create duplicate. And how much I'm getting for those? $190. Okay, not a whole lot. Let's do it anyway. Okay, so 19 cents. I usually would not bother with that. I'd rather, if the market collapsed, then Cisco, then my long puts will appreciate. But this will expire for sure today. Or you could sell it, buy it back for 1 penny or something like that. But it will expire today for sure. Let's go to Gilead. All right, Gilead. It looks, the shape of it is pretty good. The deltas are, as you can see, deltas are high. Let's take a look at a chart. It's going down. All right, so let's sell one call. This is completely optionable, up to you, you know. Not optionable, but it's, you know, is your choice. If you want to do sell one, get $655 out of it, and reduce your deltas to 9 in case the stock continues down. Okay. If the stock keeps going higher, then obviously the long call will appreciate, and that will keep us going. All right, let's move on to GS. Okay, this is looking good. You can see that the smiley face has been exceeded slightly. So we go to our long calls. We have, let's see how many calls we have. We have one short, two longs, okay? And we could certainly roll up one of those, one to 350 to 170, just to one, because we have one short, two long, so 2 minus 1 equals 1. That's the one outstanding call. We can roll that up. Analyze rolling. Just one. We are going to what we're buying is the 370 rather, 370. And it needs to be the exact same expiration, and that gives us $1,337. Let's put the 40. You can always change that. And so just so you see what it looks like, without it is a 32 delta, with it is 16 delta. So I reduced the delta a little bit. It tends to neutrality, take some money off the table, and by neutralizing is we don't care if it goes up or down. Let's go to LMT, and this stock has been declining strongly. I don't know why it's losing money, but you can see that these two options expire next week, so they have 7 days to expiration. We can roll them over, or you can see what has this stock done for us. Okay, you can copy all of these. Better yet, let's do something here. I'm going to demonstrate how to generate the price, taking all of that into consideration. Okay, the easiest way is to export the file, and wait a second. Okay, and I'm going to say here, I'm going to put it in another location. Let's go to the desktop, input it, put Colgini videos alias 2. Okay, I'm going to put it here, and it's a CSV file, and I'm going to put LMT so I remind myself what that is, save it, and then I'm going to take it into a spreadsheet. Let's create a new spreadsheet, or simply file, open, and we locate the same file that we just saved. Here. Okay, now find trade history. Okay. It's kind of messy, but let's see. What is it doing? There we go. That's what we needed to do. Now let's find trade history again. Here, okay. Okay, I need to copy this. This is my trade history. It really is not supposed to look like this. Okay, here we go. I'm going to select this area where my trades are. What I was showing you in this platform. These are all my trades. I'm going to copy that. Let's go to another sheet. Insert new sheet. Yeah, there. And paste it there. We can delete this column. Okay, and then we can organize this a little better so you can see what I'm doing here. All right, here. So in this last spread column, I'm going to say equals, and I'm going to say the quantity times times 100 times the price. This price, not that, not the net, but this, the price. Enter, okay? And that's the price for this particular call option. I copy them down, say the same formula for all the others. Okay, and here now we're gonna insert formula. In an Excel spreadsheet will be very similar. And we're going to sum. There you go, automatically creates it. And 6910. Okay, divide that by 10 will be 69.10. Okay, good. So we create analyze trade. And we're going to say exactly what we have here. January the 20th. Okay. 69.10. And then you see how much money we're losing on this trade. There you go. $1,600. So then I say I don't want to lose any more money. And then you have the choice to wait until next week or just simply close it right now. Okay, let's say the stock continues lower. Is it possible that it will continue lower? It seems like it's bouncing back. Yeah, it could continue lower, but the earnings are coming up. So I said, okay, I'm going to take my losses here. So then you say analyze opposite. And we lose $1,600. I don't want to roll it over. I don't want to do any more. I just want out. You can modify it, but you know, in my experience, you may as well cut your losses where they are, as long as they don't go over $2,000. Okay, that's it. We're closed. We take our loss and move on. Okay, it's better. It's a decision point. Do I roll over a loser? No. I just get rid of it. And that's a decision point that is a yes or a no without hesitation. And $1,600 is what I'm willing to lose in one trade, no more. Okay? All right. So let's move on to, I think we're pretty much done, except for Starbucks. In the case of Starbucks, okay, this is being moving. Okay, let's look at the monitor tab, and we are going to do exactly the same thing. Okay, or better yet, you can just simply account for this right here with a calculator. Okay, that's the other approach. You can put the spreadsheet so there is no confusion or possible miscalculation. Okay, 21.79 times 5. Okay, times 500. And let's clear my memory and store it in memory. $10,895 is my original cost. We're going to subtract 3.29 times 500, because again 500 here, okay? 5 lots times 100. Okay, so we're going to subtract that. So we subtract from memory. Memory recall, now our cost is 9,100. And we have 1 here, which is $1,285. We can just subtract that, minus 1,285. And this is the total cost of my trade. Let's copy that number and analyze. And you can see the resulting shares here, 17, the resulting strike prices, the resulting expiration points, and we have 9 instead of 10 calls on the long side because we sold the 1 call. Excellent. Okay. And now we know the price. We copied it from here. 78.15. 78.15. Okay. Now let's hide that. Let's hide the position. So the simulation is the actual cost after all the trading that we have done. And you can see that, oh yeah, we have a loser here, but there is a chance still. We have until next week, and you can roll over the calls, but not the puts. We can wait until next week because we are way out of, if it was close to the cone, then I would definitely be thinking, well, it's time to take a losses. Well, no, this stock is rallying, making new highs. Oh, then we have earnings coming up. And when is this earnings? On the 2nd of February. So there's plenty of time for that. Okay. Next week is the expiration. Okay, so we'll wait for this to see if there is a good chance the stock will rally. And look at this. We have the current price is above the smiley face, so we can sell another call. Why not? Okay, we have already sold one. We sell another one. Okay, and that makes it more neutral. Negative though, so I'm not going to do that. Okay, because it ends up negative. You can roll it up. Oh, this one here. Okay, so let's keep that as it is. All right, so I'm going to go through my trades here and adjust. So yeah, we could adjust those so they get filled. And you can reduce by 5 cents increments or decrements. Let's unlock, confirm and send. And let me just demonstrate as I would do this. I usually say I don't bother using your time for that, but cancel, replace, 1, 2, 3, 4, 5, and I'm reducing my or asking price to something between mid and natural. Okay, so that's what I'm going to do until they get filled, all right? That's all for today. Thank you very much for joining me, and I'll see you next time. Bye-bye.